Yo, Johnny B back, Creative Financing with JB. This week, exciting and great again. There's some lending news that we're going to share with y'all so y'all can keep an update of what's happening out here in this industry. We know that we have seen that we had some changes in our presidency and everything, and people getting a little shaken up and they kind of worried about what's happening in the mortgage industry. You can't stop investing. Whatever happens, political, all that, that does not give you the opportunity to stop and not do anything. It gives you the motivation to keep moving forward and do something that can get you to the next step of your career and the next step of your journey. So I want to keep encouraging y'all some things that y'all have to do and have to be aware of. This week, we're going to talk about some things the lender might ask you. You have no question why they're asking you. Why is so important? What does it mean? Why is it even valuable information? But it helps us in the loan process and for us to understand where we're going in our journey and how we're going to get it there. This week, as you know, you go through this loan process, you start asking questions. Am I ready? Do I know what I'm doing? Is this the right move for me? All of that good stuff. But the question is, have you prepared yourself to do this? Have you stepped to the next step of your journey in home ownership to get you where you need to be? So I'm going to talk about you doing some things that have happened. You probably met and figured out that your rent's a little expensive. You either want to buy and invest, but your credit might not be where it's supposed to be. And we're going to have that conversation on credit next week as we're going to bring Reggie back in for it. So we want to be able to get you situated with your credit's not ready, or it's not A1. I said A1 because you don't have to have perfect credit to buy a home. You just have to have feasible credit, and you have to be a viable buyer in that. So in this whole realm, you went and you see all these obstacles coming up your way, and you have to go to the next step. What do I do? Do I sit back and I wait for stuff to happen, or do I just get in there and and I have a conversation with my loan officer about what's going to happen? Why is it going to happen? What's it going to do for me? I'll tell y'all right now, call up your loan officer and start moving, because what you don't want to do is wait till when you think you're ready. You're not ready. Some things you forgot about, and you don't waited some months that you could have been working on these things over the time, and now you feel like you're back at square one. You're getting disappointed, you're getting discouraged, but you got to keep pushing, you got to keep moving, you got to get that energy flowing in you so you can get to that next step. So some of the things that happen, you come in there, you fill out the application. I'm looking at your credit, and you have a lot of addresses where you done lived and stuff that can kind of ask the question. I need a lot of explanation of the times and dates you lived here, because the underwriter, when she gets that credit report, they're going to look at those things, those addresses of where you lived, when you lived there. Even though it might have been years ago, if it's still on there, we should think about cleaning that up, so we'll have less questions to ask on those addresses that's coming around, that's on that credit report. And we don't remember. I don't remember where I lived 10, 12 years ago if I had moved, and I have been to a couple of different places. It's not that you have bad memory, but it's a lot of information to obtain to get it. But you want to be as thoughtful as possible in this process. So we won't, that's one less question we're going to have to go through underwriting and ask. My second thing that we're going to ask is that the inquiries. I looked on there and I tell people they don't have to tell me they went to someplace else, they done applied. Your inquiries tell the story. Your inquiries on that credit report, it tells you where you at, what you're doing, what you have done, who you applied with. Um, and those are questions that's going to pop up. You'll have something they call credit inquiries request from the underwriter to make sure that you can identify if you got a new mortgage, if you got other money that's not listed on the credit report, because it takes some time for the credit report to update to get those things going. Those things are fundamental in understanding where you're at. So when your lender asks you, hey, are you shopping or are you just going? Your credit report's going to let us know. It's going to have the date, time, the company, the credit bureau probably that you pull from, and it's going to stand out for you. And you be like, oh man, I didn't know that. I didn't know that they would see that. That's why transparency in this whole process is the best thing ever. That's why a lot of folks that when I talk to them say, man, tell me your story. Tell me how we got here, what you're looking to do. Is this your first time? Because all those things can calculate it. It depends how we structure the loan based on that thing, based on those circumstances and what we have. If we have some bad credit items, if we didn't pay somebody, if we have some folks that gave us some things that we might consider to do on our credit for, all those things need to be brought forth for us. And the reason we're asking, because the underwriter is going to approve your loan. They're going to make that decision to move forth with that loan, to get it going to the next step. And one thing leads to another. To open a can of worms with the underwriting can make it a long, drawn out process. So just be upfront with it. If you're not ready today, you're not ready today. It's understandable, but you have to tell your loan officer what's going on, what's the situation. If you're dealing with another loan officer and y'all having a bad relationship, let somebody try to talk you through that. Maybe it's something you didn't understand what they asked you, so you can't get upset, and you can finish out of consideration working with that loan officer to get that deal done. If the loan officer tells you they can't do the deal, that's a whole different story. If they have not responded to you in the time frame and you have to move forward, that's a whole different story. We have to be able to be very, very transparent in these conversations. And why I'm saying that is because these questions come out. It's something that happened. It's something that we go through each and every time to get stuff answered. We cannot deny the fact that we have some issues with what we're trying to buy, with our purchases, with the requirements. If you need to understand the requirements, ask the questions. When we ask a question, you ask a question. It's an open conversation. It's not adversarial. It's just open communication to say, hey, this is what's really going on. This is what's happening. This is where I'm at with that. Is that a way to overcome that? And you might get the hardest answer be no. This is what needs to happen to overcome that. Or we might have an underwriter that we can send a scenario to get those. These questions that we're asking is enabling us to get you through this process so quickly, streamline, and make it happen. A lot of folks think that it will never come up. Those questions are going to come up. So anything on that credit report we might need to know about, called repo, voluntary repo, charge-offs, you have stuff in dispute, you have somebody stole your identity. All those type of questions are important. All those answers and understanding are important, so we can go ahead and be ready, prepared for the underwriter, because they're going to see it. They're going to go through their process and they're going to look so diligently to find out what's all this stuff? If you're doing a manual underwrite, that's even more. People say, what is a manual underwrite? A manual underwrite is where we don't use an automated system to see if you're approved. The underwriter has to look through every step, every account you have, look to see if you have had any late in the last 12 months. If you're doing a manual underwrite, it's important to let us know, hey, before we even start, have you been late on anything on that credit report in the last 12 months? If you have, we can't do it because manual underwrites require 12 months on time payment performance. You have to have that to go manual. What do I mean manual? If you got a 580 credit score or maybe 619, 620, you're in that range to do a manual underwrite. Can the loan be done? Absolutely. People all day long are able to get loans with manual underwrites, but it's a more tedious process. It's more into depth of what's going on in that credit. While we can't get her through him through the automated system, what's been going on in his financial history? Is he's working? Is he consistent with his job? All those things need to be dissected to figure out what's going on. And it's okay to let us know that, hey, I got hurt on a job for a couple of months. I was getting, disability until I got back to work and stuff. We all have situations. Those are open conversations to have with your lender, to talk it through, to make it seem to make it seem very transparent in this process, because what we don't want to happen is somebody else come or the underwriter come and say, hey, you didn't see this? It didn't pop up for me. It happened. They have another system, and y'all hear about AI. AI is so prevalent in this industry here where stuff is coming up and you don't even know it. I had a guy, he got investment loans, and some investment lenders don't put those investment loans on your credit report. But through their AI system, they can see any other mortgages you have on there. So they're going to come up and they're going to say, hey, I seen you just close on this loan. It's not on your credit report. Well, tell us about your investment properties. Tell us about the real estate you own. It's not a bad thing, long as we have rental income going on from there. It's a couple of questions we're going to ask about that rental income. Has it been 2 years? Did we put it on the taxes? Can you show the first and last payment? Could you show the payment for the last 2 months? Those type of questions come up so we can be able to answer those and see how we can address those situations. If the payments have not been cash or something, how'd you get it? Did you deposit that cash all the way in the bank so we can see that clear deposit for that rent? And the underwriter said, oh, okay, he got cash. He deposited the whole amount in the bank. That's rental income according to the lease. Is the lease accurate? Is the lease up to date? Are we month to month? Those questions is not to just dig into that rental income, because we have to know where you're at with that. You can't give me a lease that's expired and I'm saying, here, underwriter, this is what they still charge it. No, we have to know that it's a month to month. You have to give us something that say, hey, the lease expired. The tenant decided to go month to month on the next agreement. I recommend that you get some type of real estate professional to help you in that avenue, that does property management or something to help you with that month-to-month lease if you need one. Those type of things that stand out for it if you have that rental income. So just because it's not on your credit report, don't think it's not going to come up. It's out there. It's available. It's right there. So transparency in this conversation with your lender is totally important, because we have to head it off before we get to the process of them, the underwriter finding out what's going on, the junior process of finding out what's going on. When we ask you for pay stubs, give us the pay stubs. Give us all pay stubs that you have. If you're working more than one job and stuff, and you say, hey, Johnny, I just want to include this job, that's fine. But we need to know that. We need to have that, because what happens is we do a verification of employment. Guess what comes up on a verification of employment? All the jobs, active and inactive, that you have. They are available for us to see. And we don't want to start asking questions about, oh man, you didn't tell me about this job. Are we using it? What's going on? How is that working out? We might need the income for it. So verification of employment is a form that we get. It's online. We'll go ahead and put in your name, your social, that into your database, and that comes up. It lets us know all the jobs you have active and inactive for the last couple of years and where you are with them. It don't tell us if you're fired or not. It just lets us know that you work there or you don't work there. For which what matters. 2-year employment is what we're looking for. So we can go through that whole step of understanding what that employment is, what that employment does for you. You can't. I don't want you to think it's a bad thing to say, hey, I want to use this employment, but I don't want to use that right now and stuff. It's fine, long as our debt to income ratio is okay. That'll be real fine. If it's out of whack, if that debt to income ratio gets out of whack, I'm saying, hey, we need that other job. I need them pay stubs. I haven't been working it. I need to know, have you been working it 2 years? If you've been working it 2 years for an FHA loan, it's important to let us know, because that's a requirement. 2 years FHA. Conventional, you can get away with 1 year, but everything's going to be 1 year for it. Those type of questions we're asking, not to just get in all your income or what you have. Biggest thing that we have outstanding, your assets. Money to close, money for down payment, money to utilize for us to close this loan based on the closing costs and down payment. Tell me, Johnny, I got a 401k. It got $130,000 in it. I also have money in my bank accounts. I just sold a property here. So I have this money left over. Those are good conversations, because guess what comes up on the credit report? On the credit report, it comes up with that property. If it has not cleared and it has not closed out to show paid off and stuff, it might pop up. It's an underwriting question. Hey, we see property 123 Main Street still have a mortgage payment of $2,000. We're able to let them know, hey, here's a settlement sheet from our sale of that property at 123 Main Street. So that credit report should be updating really soon. It gives the underwriter comfort that we're just being upfront and honest. When they start digging, as people said, they start digging, they start finding out something, it opens up a whole lot of questions. It opens up a whole lot of conditions that need to be met for this process of going through funding this loan. But we just want to give them the best scenario error, that we have a good viable buyer. They're trying to purchase a home. They sold their previous home. They want to upgrade or they want to downsize. And they say, okay, that's fine, and go from there. If your job's relocating, or you'll hear this, I'm coming to Delaware because it's cheaper to buy a house. I live in Philadelphia. I make good money. I'm a nurse. I'm a doctor. I'm a lawyer. The question is, how far are we commuting? Because at some point in time, when you're working long hours, that commute can get overwhelming, and we have to protect the interests of the bank of us paying back that loan. So for us to go out here and just say, oh, I'm doing X, Y, Z because it's cheaper, the taxes are better, make sure we're within the guidelines, 100 miles or less. Are we going to be commuting? Because that's going to be a question that's going to come up. They're working all the way in Jersey and they're buying a house in Delaware. That's like 102 miles. Is that job coming here? Are they working remotely? What's happening there? If you didn't explain that to us at the beginning, we're not able to give the underwriter the best scenario possible. Um, I didn't know that. Put that in consideration. Absolutely, because when you're traveling, they have to look at, hey, how often somebody really going to travel like that 5 days a week? 100 miles, they can find something a little closer to where they're at to live, but you want to come here because you get a bigger bang for your buck. Those type of things are important to know. You have to display and explain that to your loan officer. Or if you're working remote, we can say, hey, underwriter, we only got a 3-day work week. We're driving 100 miles, 3 days a week, and everything. You consider a risk. It is a risk. And the reason why we're a risk, we're driving a lot. Your body gets tired. You have commuting problems. What happens? You start getting attendance problems at work. What happened that you're not making it on time, and you start to get up under this attendance program that your company might have, and you start getting on warning. The bank have lent you money that they expect repayment on, and once that repayment to be comfortable, that's why we have these type of questions come up. Sometimes your insurance goes up, and that's another cost to you that can affect your you paying a mortgage, for it and stuff. My insurance was $100 a month for my car, and now I'm driving 100 miles. It went up to $300 a month. That's a $200 difference that we're looking at. That's more gas I'm utilizing. So we're taking away from the money we're earning when we have those commuting, those long distance jobs. Sometimes nurses, they work 12-hour shifts, and they back to back. So them driving and coming back takes away from the rest that they need to perform. Now, at some point in time, they start looking for other employment because it gets to be a lot. Those are some of the things we have to look at when we're commuting, going back and forth up the road. So if we're asking you, hey, are you close to work? Will this be a perfect situation for you? You're able to come through and say, hey, it is. This is what's going on. This is what we're doing. And this is how we're doing it. For the commuting. Is your job, have you been at your job for 2 years? People think that they have to be at that job 2 years. Same field, same area of business, 2 years is what you need. You need that because you have to be able to have stable employment. If I'm switching over from engineering to nursing, from going from real estate investor or landlord to a W-2, whatever the job scenario might be, that can be a break in the action, and we might have to do something different when we calculate your income, where they talk about variable income. What is variable income? Variable income is income that we calculate over 2 years, divided so we can see how much you're really making monthly. You started a new job here in January, but you've been doing something else along the way. You have a new form of income that you got to look at and for it, and we have to use it as variable because you're new to that type of position, to that job, for it and everything. This also helps for us if you're a first-time home buyer. Improving your chances for that pre-approval is all these things I'm talking about, because we're stepping into a realm of home ownership, longevity. This is not like usually renting. When you rent, sometimes, people might stay there 10, 11 years. That's a long time to be renting someplace. Sometimes longer than that. It just depends on the landlord and if the price of rent went up and everything. But if it's a comfortable situation, then we're fine with that. The question that we have to be mindful of is that are we prepared to do this, especially in first time home buyers? I always had to think, yeah, I'm a first time home buyer. What am I getting out of that? First time home buyers, we have programs for you. We have tax exemptions, we have tax credits. All that stuff is great for you. If I'm not a first time home buyer, will I be able to get down payment assistance program? Absolutely. You still have, it's still programs out here for down payment assistance, and you can utilize them. What you'll notice in Delaware, um, after 3 years, you still can get your exemption in the city of Wilmington. But if you have ever owned in the county outside that area, you don't get that same transfer tax exemption for it. So that's something else to be mindful of. For first time home buyers, all these job requirements and having that money saved up and put to the side is very important for your chances of purchasing this home. It's very important that when you're looking, that you look at something that's reasonable within your reasonable price range, because we have to look at where have other costs that's associated with it. So now you starting to talk about trash, and you had lights before, and now you might have a water that you didn't have before. And then you talk about upgrade on maintenance. I want new curtains for my living room. I want some other new items in that house, and it's extra funds. My grocery bill might increase, because I have company sometimes. I got a new house, and that happens a lot. I get a new house, my friends, oh, let's go see the house, let's do the housewarming, blah, blah, blah. That costs money. It changes the whole scenario. In this home buying game, we have to make sure your change of life does not change dramatically in this process. It has to be consistent on how you live. We notice that a lot of folks that come into foreclosure or something like that happens through a lot of ways: losing their job, the income have decreased. We had increased taxes on our home property. We can't afford the taxes. The insurance went up. We have a major repair in the house that needs to go. Do I just pay my mortgage or have that fixed? And I fall behind. All those things happen in this process. But guess what? We have to see a way to do it. That's why we have to manage our income, our budget, and keep going till we get a level of comfort. I tell folks, I have to be comfortable with you getting in there to know that it's going to be a comfortable mortgage for you. You have to feel comfortable with the purchase of this home. And this is why I'm asking you these questions. You might hear that, hey, what do you do? What is the percentage needed for down payment for first time homeowners? Isabel, that's a great question. We have, it's so many things. You have FHA's 3.5% down. You have conventional, you can have a 3% down or 5% down. USDA is 100% financing. VA is 100% financing. Those are financing for that. First time home buyers or not. If you're conventional and you're not a first time home buyer, it's 5%. I heard a lot of people say, oh man, I need 20% down. No, 20% changes your mortgage insurance if you're doing that. So those are things you have to be mindful of for. If you got 20% down, is that good? That's great. So we're not emptying your bank account once you move in this house. I tell folks, do you have you considered moving when you purchase in this house? Have you considered how much the truck's going to get? Have you considered you got to turn on lights? Have you considered you got to buy food and all those type of items? For those things are necessary for us, and this is what it is. So and that's important. Are there no down payment loans anymore? Zero down payment comes with VA, USDA. So it's nothing down. That's 100% financing. So if the purchase price is 250,000, your loan amount 250,000. Well, you have the USDA, you have a funding fee for VA, and you have the USDA financing fee as well, for it as well. Do they have programs where they have to cover the down payment? You do have down payment assistance programs that offer you 3.5%. So if we're getting an FHA loan, it's 3.5% down. So we have down payment assistance programs that have to cover that 3.5% and maybe a little bit of your closing costs. If people say you don't have to go in that house, you can go in the house with zero money down, please reevaluate what they're saying there. For you might be able to piggyback down payment assistance programs, but the question is, you still need money for the appraisal. You got to leave an earnest money deposit when you write the contract. Those things is not covered with down payment assistance money. So when they say 100% down, yeah, they're talking about for that down payment. You still have closing costs. Is it going to cover all my closing costs? It's possible if you have more than one loan that you're going to do to piggyback on the other one. That is totally correct. So yes, 100% down programs, but it's down payment assistance to help you cover that 3.5% down for your FHA. And I only know a few banks that do it for conventional. That they help you with that 3 or 5% down for that conventional as well. Remember, these programs require credit score. So when we're asking you, hey, what do you think your credit score is? Where are you credit wise? I'm good. I'm looking at Credit Karma. I'm looking at Experian. I want to make this comment real clear right here. The closest thing you can get is myfico.com. It's free to start off, but to get your mortgage score, and you have 3 different scores. You have a mortgage score, you have your automobile score, and you have your credit card score. Those 3 are different scores. So if I tell people, if they want to be accurate to what it is, go to myfico.com, pay the $29.99, get that score for your mortgage, so you know what that mid score is. You're within 2-3 points, almost. Don't go out there and look at these Vantage scores, because they're not going to be accurate for you. They're not going to give you what you need to see, because they might not be calculating something that's on there, student loans, collections, and all of that stuff. They might take that away because you disputed it, and they feel that it's not valuable to the credit report. We still think it's valuable. It's got to be valuable, because it's information that we have to be able to see what's going on with it, because we're lending money. We're being able to find out where you are credit worthy wise. So those are important. MyFICO.com stops the inquiries. It's not a guessing game. And in my conversation with folks is, you get myfico.com, you're going out to buy a new car and stuff, and they have a 0% interest rate program there for you. Oh, which bureau you're going to use and what the credit score has to be. You can go right there and look at it and know if you qualify, and stop saying, I think I'm there. No, it's no need to think. You can know what you mean when you are there for it. I'm going to clarify something too, if I overlooked it, is the piggyback loan. What do I mean by piggyback? Okay, we have a loan and we get down payment assistance. Give you a quick scenario. So we have down payment assistance for state, county, cities, federal, whatever they are. So you might have a down payment assistance, and I'm just going to use Delaware, for example. You might have a DSHA program, And then some banks might offer a second one you can combine with that first one that'll help you with the closing costs. So you might have the first front door, which you might be available for. You might have the City of Wilmington program, or you might have another program that the bank might offer on top of that. In Pennsylvania, you might have the Philly First. So what happens in Philly First program is almost like two DPAs, because you have the Urban League that gives you one, and the City of Philadelphia gives you another loan. Those are piggyback loans. It means that you have more than one down payment assistance program combined to help you cover some of that cost that you need for your closing and your down payment for it. So anybody want to consider, why should I do a piggyback loan? It helps you. It's less out of pocket. It's more money that is available for you for closing on a home. Folks, I'll be regretful not to give you my number. Feel free to give me a call. Johnnie Bazemore, 302-312-9860. Or you can reach me at johnny@yourcreativemortgagelender.com. And, so we can have that conversation and we can make sure that you have that understanding of what you should be doing here to get this. Down payment assistance is a great idea, but you have to you have to be understanding of how to use it, what's the benefit of it, and why we do it. This is important. It's good to have your own money as well for it and stuff for it. But these down payment assistance, they help. Are there interest rates on some of them? Some of them payable, some of them non-repayable. You'll have to go through that whole scenario. Which ones am I going to use? Sometime one runs out and you have to go to the other ones that's payable. The non-repayable, the funds ran out. Now it's the payable that's available for it. It might be a high interest rate. It might not be a higher interest rate. Those things are important, and those are questions you have to ask your lender. How is this going to affect me for it? Is it beneficial to me to use it for it? And why do we use them? Why do we have to go through this process? And I tell folks, this is not just because you have it available, but look at the benefit for using it. Are you going to get a tax break on it? Or are you just going to be able to save some money and still have an affordable mortgage? Is the interest rate, if it goes up a little bit because they're giving you this money, is it going to affect you in the long term for how much you pay monthly? All those things are so important to the whole scenario. There's the email going across the stream. Send me an email, send me a text. That's my cell phone, because those are conversations we need to have so we can understand. This is just not finding a loan officer. This is an education process. This is something that we have to go through. Questions that we ask. Don't get disappointed at your lender when they're asking these questions. Don't get upset because you think they're in your business. We have to know what's going on here so we can put you in the best situation ever. A lot of folks get there and they be like, man, why is all these questions I've done and fill this out and I gave you these documents? Those are questions that they might forgot to ask. Or the underwriter's seen something and trying to get it all out, and you might not give them the whole story up front, so they're going to pick around it until that has to come out. And they specialize in this as well. Please understand that when we're doing this, it is for the betterment of protecting the loan. It's protecting the bank to make sure that we can give more loans out. The more loans that we're giving out, the more the banks have to service those and continue to go forward with them. It's a process in itself. We're going to talk about reverse mortgages. People say refinance or reverse mortgage, refinance or reverse mortgage. One key thing with reverse mortgage, if anybody can never guess what that is the age. It's the age of a reverse mortgage. Start at 62. But the breakdown of how you do a reverse mortgage, they average it to age 99. So the younger you are, the less monthly you're going to get for a reverse mortgage. Is a reverse mortgage beneficial? Absolutely. It's a great idea for folks that need to increase their income over the time that they're here on earth in their golden years, that they might need that money. They might need that money to live. They might have to go ahead and use it for food, medication. So many things has changed, and as we know, these prices are increasing tremendously. So reverse mortgage provides extra income. No, they won't have a mortgage. People say, oh, the bank's going to take the loan, take the house from you and all that. When you sit down and start looking at a reverse mortgage and the benefits of it, a reverse mortgage is just using some of your equity up front, using some of your equity to live before you leave this earth or transition for it. And guess what? The benefit is that you're living in peace. You're in those years where you shouldn't be struggling. If you can go watch a movie, if you can go have a plate of food or something like that. These are times that you might want a little vacation for it, and you want to use some of that equity that's in the house for it. What happens once you transition and you go on? Well, your loved one will have the chance to refinance, get the home back, put it up under their name, pay the reverse off, and keep going. I like to tell people, I think of it like a credit card. We use a credit card every month. A credit card, we benefit from a credit card by going out and getting the money we need to use certain things for rental cars, for when we go on trips to hotels, if we want to go out to eat and we don't have that money right there and we want to use it next month and we put ourselves on a budget. We have to think about that same thing for a reverse mortgage. It's a line of credit. People's just using that equity up front before they just pass it on. So people say, oh man, it's a bad situation. I know that if I was in a situation and I know that my children or something, can afford this, or they want to take over the house note for me, take it over. Take it over for me so I can enjoy some of my last years and get to travel or something like that. Because when I'm gone, the house is going to be yours anyway. I'm going to pass it on to you because I'm going to have a will or whatever. But right now, today, I need that to do something that I always wanted to do. And that might be travel. That might just be able to pay off, be able to be free of some debt. My retirement's not that great as pensions and stuff. So those are questions that have to be answered. I ask those questions when people refinance. Do you have reverse? How much you on your first? All those questions stand out tremendously. So we can do one thing: make sure that we have the funds available for when we're doing stuff for it. Don't look down on reverse mortgage. Don't think it's a selfish idea, but give me a call. We can chat about it. 302-312-9860. That's a conversation. It's an honest conversation. It's an open conversation for you. When we doing those things, send me an email to johnny@creativefinancingwithjb.com. Those type of questions and scenarios we talk about every day. It's something to discuss. It's nothing to persuade you either way. Refinances, people say, oh man, the interest rate's so high. It's other ways to do it. HELOC, line of credit. There's so many things. You just got to qualify for those things. Those are items that have. We're going to ask you for that HELOC. You got a 680, 700 credit. We want to see you're a viable credit buyer. How much equity we have in the house. How long have we been in the house? Do the house need repairs? What are we doing? Those are questions we're not asking for our own reason, because we have to answer those questions, the reason for the cash out. And those are viable to know for folks that are looking for one of those streams of income, of finding out what they need to do to get to the next step of how it's going to happen. Why are they at this point in time just looking at this for why you didn't consider it earlier? As we look for our interest rates to drop, we we we're going to see a lot of refinances, because we had a tough market the last couple of years with the interest rates and stuff, and they're not the best interest rates, but there are interest rates, like they said, don't marry the rate, just date it. We're dating right now. Are we dating a little bit longer than we want to? Probably so. But guess what? We want to make sure that, and this dating is still affordable. If I ask you, I'm like, what is comfortable for you on a mortgage? Don't estimate what it is. I want you to be upfront, honest. Tell me, Johnny, I don't want to do no more than $3,000 a month. And this is the type of house I want. I'm going to tell you, we're going to talk to your realtor, see if they can find you something. I'm not going to be the one to tell you with the people selling that house for why it's that price. What's important is that we find something within your price range for what you can afford. So when we ask you, what's your comfort level? Somebody might say, what's your appetite for? Be honest up front. Don't overestimate it based on what you have. Don't go beyond what it needs to be. We have to be very open and honest and transparent to where we want to be financially. If you can't afford it, maybe right now, it might not be the best time, but we have other programs that if you need to buy down a rate or something like that, those are available for you. Those are something that can get you through to the next step of the process. We have to look at all options, but these are conversations. Why are we not having these conversations? Why are we not asking these questions? Why are we not thinking they are feasible to what we need to have if we want to buy a house? It's okay to question those and see if it makes sense to you. You have to give yourself an opportunity to say, hey, if I do this, will it make sense? And what's the time frame it makes sense for? People do buy downs 2 years, 1 year. They had a three-year buy down for this stuff. We have to consider all those options in this mortgage field, in this industry. And why do we need to consider them? Because we're investing in ourselves. We're investing in what we have to do here. And that's what's important to us, for us and everything. We have to give everything a fighting chance to understand and make it the best situation possible for us. And we can't give up on it. We have to know that these questions are informative. They're very important. And going from there, when we start asking about income, hey, I want to know what we're talking about yearly, because some down payment assistance program have income guidelines. We need to know that based on household, based on how many people's in your household. These are questions that we have to do it, because if you can qualify for everything except one thing, and you don't qualify for the down payment assistance program. Some down payment assistance programs don't have that, but guess what? They're gonna say, hey, it's repayable, and it's 2% higher than the first. You're like, whoa, that's a lot. So if my first mortgage is 6%, my down payment assistance is gonna be 8% over a term, for it and stuff. Will it have a balloon? It might have a balloon after 10 years. It just depends. It's the requirements. Those are questions you have to ask. How will that affect me if I refinance and stuff like that? This is how that affects you. How long do I have to refinance? 6 months, 12 months? People tell you that It's 12 months for FHA. It's 6 months for conventional. It depends on the bank. Some banks change and say, hey, we'll do 6 months if it's FHA. We don't know. We have to ask those questions. Just like we ask the underwriters questions and we ask the leaders at the banks these questions to be able to go around these scenarios. Same thing I want y'all to do. We're asking questions to identify where you should be at, what's comfortable with you, and what's to protect your greatest interest in this home ownership process. The question is, are you ready and preparing to move to that step? Are you prepared for these questions? Are you prepared to understand that this documentation has to be in line? Do we have our pay stubs? Do we have our W-2s? Do we have our tax returns? Do we have our bank statements? Do we have money to close? Can we get a gift here? How are we planning to do this? Those are questions that we're asking, so we'll be able to document the loan going in. And when we document that loan and when we have that stuff going forward, boom, it makes it a whole lot better. It gives you the opportunity to say, hey, this is what I'm doing, and this is what I would like to do, and tell me if it's feasible. If it's not, we have an open conversation. Hey, I know you want to figure that they can give you down payment assistance and you can piggyback a loan to down payment and closing costs. But right now, that second program don't have money available. Can we get a gift from somebody? Can a family member fill out the gift and provide the documentation? Folks, when we ask for them documentation on the gifts, I want to be very honest. Sometimes they ask for the from the person that's given the gift, the bank statements for the last 2 months to show that the money was available in the account. We don't want nobody to go out there and take a second loan for you and then say, hey, I got your gift right here and they're going to pay this on the back end and all of that stuff. No, we have to see that the money's viable right then and there, that it's not just being halted, borrowed from someplace and we trying to figure it out. This is gift money that you're filling out and you're signing a document that's saying this is gift money. We have to see that wire come through. Are they going to wire that money? Are they going to give a check, to the title company? How is that going to transpire? People say, oh man, what difference do it? Makes a whole lot of difference. We need to make sure the money's available for closing. So the sooner you know you're getting a gift, the better it is to prepare for the gift and the amount. Go off the loan estimate. Prepare yourself, go off the loan estimate. Why do you say that, Johnny? Because if you're going higher, then you know that that's less money that you're going to need. It's going to be available for you. It's going to be feasible for you for it and go from there. For it, I'm asking the question, you think you're going to do a home inspection because that's more money? So we can include that in money you'll need for closing and you're going to put in to the home, all that's relevant in this whole scenario of getting to this home ownership and questions we ask. We ask you, we might ask you, are you going to have a non-occupied borrower, to go on here with you? What does that mean, John? That means that somebody that's going to be like almost like a co-signer for you to be able to go and assist you qualifying for the loan. That's what that means. Those are so important in this game that you have to know where you're at with it. It's not strange questions. It's not nothing to scare you. It's to prepare you for that journey of what we're doing next, how we're getting to that next step, how we're going to make sure that we get to closing table, get to the table, get it done, and be able to say, hey, we got a good loan here that we're doing. Folks, I'm only here to provide the resources. Reach out to me, Johnnie Bazemore, 302-312-9860, or Johnny at creativefinancingwithjb.com. just reach out. Let's have a conversation. Let's talk about it so we're able to work through this stuff, that we're able to get you to where you need to be. And the most important thing is to ask yourself, am I truly ready? Have I looked through all scenarios? Have I weighed all options? Have I looked into what I need to do to get this done? That's where we get to the strategy of this home ownership, of answering questions, going through the scenarios, and providing that documentation. Make sure you save your documentation. It's tax times, folks. Save your money. Put it up. You're buying a home, you're paying rent. Put it up for a little bit longer so you'll have money available for when you get into your home. You want to buy nice things. You want to have nice things. You want to have saving. You want to be able to go to that next step. If you're a veteran, I'm a veteran, man, we have the 100% USDA out there in the rural area. Look at all options, what you have, new construction if you can. But you got to know the rules. You got to know the outline. You have to have a conversation with your lender so they can go ahead and provide you with the best scenario possible in this strategy. Folks, I'm always delighted to talk to y'all and give y'all this opportunity to reach out and get the information you need. I'm here as a resource for you, here to go ahead and make sure that your lending experience is the best experience that you have. And guess what? We're all homeowners. We just own at different times in our life. Folks, this is this Creative Financing with JB. Tuesday next week, I got to get my credit guy on here because I got to break this credit down to you and let you know and understand what's going on here, why the game is the game of having good credit, having bad credit, not making bad decisions with credit, and making sure that it all makes sense. Folks, thank you for watching tonight, Creative Financing with JB. I'll see you next Tuesday. Thanks again.